Welcome to the debut show of the Texas Capitol live stream. We're debuting here live from Dallas, Texas. It's an exciting time to be doing this. There's so much going on in the capital markets, so much going on here in the state of Texas in terms of being a new global hub for capital markets. We're excited to talk about that. We're really excited to build up to the event, the TexCap Future Finance Conference. We'll be hosting October 8th right here in Dallas on the SMU campus, just across the street from where we're sitting. My name is Steve Kennard. I'm the president of the AI Innovation Association. I have with me my colleague and my good friend, Lee Bratcher, who's the president of the Texas Blockchain Council. And producing the show for us, we have JBA, recent grad, entrepreneur in residence. And we're the team here for Texas Capitol Live. Thank you for joining us. Lee, I wanted to invite you to give us a little background, how we put this together, why we think it's important, and we're just inviting people to be a part of this new movement and talking about this subject.
Yeah, it is very exciting. We've got Texas Stock Exchange coming to Dallas, NYSE Texas, NASDAQ, all converging on Dallas as the new hub for capital markets. So a couple months ago, we partnered up with APL and NAPE to host the TexCap conference, which is going to be October 8th at SMU Cox School of Business. And that is really about bringing these public markets entities and connecting them with publicly traded companies, Dallas-based, mid-sized companies, bringing their CFOs into the room and having conversations about what it looks like to go public. There are fewer companies going public now than ever before, right. And there's a proliferation of private capital, private equity, and private credit. And that's none of those are bad things, but the public markets have been overregulated for so long that we really are excited to see that reverse a little bit. And the Texas legislature has been doing a lot of work, as you and I both know.
We'll get into that today for sure.
Yeah, we'll be in that topic later on. And so we're just excited to have this conversation. We're excited for the conference. We're going to be doing these live shows between now and the conference and beyond. As Steve mentioned, we've got Bryce producing the show for us, recent graduate from Dallas Baptist University, entrepreneur, and just a guy that we've appreciated his insights on the public markets. And we're going to go into a show today with we got 3 or 4 special guests who are going to be joining us. It's going to be a good time.
We got an exciting docket, so go to texcapcon.com. That's texcapcon.com. You can register for that conference in October there. Before we get into kind of the meat of the program, I don't think it would quite be Texas if we didn't have a little bit of Bitcoin mining going on. So we have our Bitcoin miner here, little live Bitcoin price. Looks like we're right above 112,000. We wanted to give a shout out to our friends at ACS, Advanced Crypto Services. Pretty cool little toy they put together for us, and mining Bitcoin in real life. Just a few years ago, this wouldn't have been possible. So how many more things can we be doing a few years from now? So we'll have this miner alongside for the whole show, and we'll be making a little Bitcoin along the way.
Yeah, what if we hit a block on the show live? That'd be pretty wild.
I like that. That's the mission. So we need to have some kind of bell or cannon that we need to build to go off when we hit that Bitcoin. So hey, let's get into the show. We wanted to start with a big story that's come out recently, and it seems like it's receding a little bit from the headlines now, but we think it's actually more important than most people appreciate, and that's the recent move by the U.S. government to take about a 10% ownership stake in Intel. And for me, Lee, I think that 2 things can be true at the same time. The first is that the practice of giving money away, in other words, grants to private companies from the government, which is really our money, the taxpayers' money, really doesn't make a whole lot of sense. I think that's what the administration has been leading with. Why would we give money away when we can get maybe, quote unquote, a better deal for the American people? In my estimation, though, at the same time, maybe the pendulum swings too far the other way. And we've seen now an emergence and kind of a retrading of the deal, where what was formerly a grant under the CHIPS Act has been renegotiated primarily by Howard Lutnick, the Commerce Secretary, but within the Trump administration, to flip to an equity stake in Intel, a private company, a company that has a long history, but I think most would agree recently has struggled to keep up within the competitive landscape. And what I'll say is this isn't entirely without precedent. To be fair, even going back to the Depression, you had a lot of government programs that ended up with equity stakes in a company. In the savings and loans crisis of the 1980s, you had different programs where the government ended up with equity stakes. And maybe more recently in people's memory, you had the crisis in 2008 and the kind of bailouts around that, and then all kinds of government involvement in the private sector in COVID. But what you'll notice about that pattern is these were all kind of major emergencies. Whether or not you agree with what the government did and whether or not that was intrusive, it was sort of under the banner of, if we don't do that, this is the last resort. I think this is a change in tone where all of a sudden it's more of a strategic kind of preemptive move. And for me, if I'm a CEO sitting at any competitor with Intel, I'm sitting around thinking, do I need to go make a better deal? Do I need to offer an 11% stake? And then you go to 12 and you go to 13. Even as they've said that these are not voting shares and they're not looking for a governance kind of seat at the table, I think at a minimum, it's a slippery slope. And the communication, I think, needs to be a little bit better. What's the exit strategy here? Is this kind of a hold position forever? It's a little concerning to me, particularly within a company that was already kind of lagging behind, maybe didn't really need the investment, and other players, American companies, could potentially step up and bring that innovation. That's kind of my take on what this looks like right now to me. And it seems like we've kind of moved on now. I feel like there wasn't an entire sort of talking through this from the administration. What are the potential downfalls here? What else are we going to see? There have been indications that this isn't a one and done.
Yeah.
They're kind of open to a broader initiative around this kind of deal structure. And so everybody's got to be talking about this behind closed doors. We've reached out to a number of people. We're going to have someone come on and talk about this in a minute, hopefully. But I think it's fair to say most CEOs are like, I don't want to talk about this right now. Yeah. And they're trying to sort it out. What's your take? Is this good? Is this bad? Is this more in the ugly category? What does the future kind of hold in American capital markets when you've got the White House, intermixing and kind of what looks like to me picking a winner and a loser?
Yeah, it is, I would say, concerning. And but there, on the flip side, you do have our competitive or strategic competitors overseas have been doing this for decades.
Right.
They put their finger on the scale. There are state-owned companies, particularly in China and Russia and elsewhere, where the federal governments or their governments take a stake or have full ownership
Right.
of the entity. And that entity does not need to be profitable. It does not need to publish financial statements to the general public. I mean, it is just a machine.
Yeah.
Operating in the back end. Now, that's not what we have here with Intel. Intel is obviously publicly traded, certainly not making that comparison. What I am saying, though, is I could see why the government feels the need to compete and,
Yep.
and match fire with fire. Now, the United States is different than those countries. We are a democracy.
Right.
We are a capitalistic society with well-regulated markets. So light touch regulation, of course, we could debate, the trajectory of that, all day probably. Thinking about is, what is this portend for the future? Are we going to have the federal government taking stakes in more and more companies? Right now with Intel, they're non-voting, shares. They're not going to try to get a seat on the board, but there are yet. So I say the yet is key there, because power has a way of, throughout history, you can see it with the federal government, you can see it with the executive branch. Power begets more power.
Yep.
And this opens the causeway. While this particular deal with Intel may not be overly concerning, what is concerning and what the American people should take a very hard look at is, do we want the government involved as equity owners in companies, rather than perhaps subsidizing, and I hate that word, subsidizing.
I'm with you on that.
Subsidizing is a less dangerous form of this.
Yeah.
Or perhaps creating avenues for strategically important industries to have a leg up against their global competitors.
Yeah. And that debate played out a little bit in the U.S. Senate around the CHIPS Act, which was where this funding originated. I think it's about 11 billion that Intel got that we're flipping to an equity stake here. And particularly here within the state of Texas, we saw a situation where Senator Cornyn voted for the CHIPS Act. Senator Cruz opted to vote against it. And in his communications, he said it's not that we don't recognize the strategic importance of semiconductors. It's that this is a massive kind of grant-driven program. I think that the proposal Senator Cruz had put forward was more around structuring some kind of tax incentive where as you build out a certain plant, you take tax write-offs over time and you kind of recover those as you deliver. We've seen more successful programs in terms of kind of municipal and state level incentives around loan guarantees. So you are, again, back to the word we don't like, you're subsidizing. You don't have that equity stake though. You're at least getting a return on that capital to the American people. We have a similar program here in the state of Texas for the electrical grid that's being rolled out to try to provide lower interest loans to spur reliable energy build out. The ultimate success of that is still being played out, but there are kind of other flavors of ways to support a strategic industry. This one felt like a new bold step forward. And it's interesting too, because leading up to this, there was a lot of back and forth. And at one point, President Trump even called for the resignation of the CEO of Intel. And regardless of where you kind of stand politically on that, hopefully there can be some alignment around the sitting president probably shouldn't be calling out single CEOs at particular companies, calling for their resignation, and then kind of a week later sitting down at a negotiating table with them. Seems like kind of an unfair level of leverage to me. I don't envy that CEO being in that hot seat, trying to compete in a global market. So it's something that is an odd way it was rolled out. It's something you'd like to say, well, this was a one-off, but think of it this way. You've done this deal now. These kinds of long-term investments and semiconductor build-out are fraught with, you put out a certain timeline, and for all kinds of reasons, you can't meet it. Some of that may be company incompetence. A lot of times it's out of your control. It's a complicated supply chain. You're depending on all other kinds of potential bottlenecks, and you can't deliver on a certain timeline. Then all of a sudden you find yourself in a situation where you say, well, they're going to need a little more help. But if we're going to do that, we got to go to 20%. And then we got to go to 30%. And so that's sort of that's the slippery slope that we're talking about. And I hope that we can get more CEOs and more people involved in the capital markets to say, this warrants something more like a written communication as opposed to kind of one-off press releases, one-off X posts around how does something like this work and why should it not become the default approach moving forward for every other industry. Airlines have historically been really prone to repeated bankruptcies and are also major employers, major infrastructure kind of providers. And that to me is like the next kind of natural domino that could fall here of, well, we can't have airlines going bankrupt. And you start to balloon more and more around that.
Well, we were about to have Dr. Robert Atkinson join us from the Information Technology and Innovation Foundation. He's in DC. He's the CEO of that entity and is going to give us his thoughts on that. But before we do, Bryce, while we're waiting for Dr. Atkinson, he's not scheduled to join us for a couple more minutes. Could you pull up or look up the stock price for Intel over the days prior to and then preceding the announcement of the 10% stake? So maybe like a 14-day. Let's just kind of see how the market's reacted to it. I think obviously I would say positively because they're taking those shares off the market. But let's see what it's done in the last couple of weeks, and let's see what it's doing today. And then we'll hear some views from Dr. Atkinson when he joins us.
Yeah, I think there's been a run up kind of over the past month as this has been rolled out. Down around $20 a share, trading above 24 right now. So not a small run up. Maybe the argument there would be that offsets some of the dilution. Obviously, existing shareholders are going to be diluted if you're going and giving a stake to a new entity. So maybe you're already seeing some offset there. The market in general has been moving up. And so it's something where kind of the benchmark for everything seems to be Nvidia. And so to be fair, over the past month, Nvidia has been choppy and has recently traded down from, it was over 180 a share. It's trading at 171 right now.
Mm-hmm.
So maybe if you want to steel man like a pro argument here, you're already seeing it play out a little bit in these public markets, that the kind of top dog, which I would consider to be Nvidia at this point in American semiconductors, has traded sideways to down, and you've seen a little bit of a recovery in Intel. Now, if you zoom out over 6 months and a year and 5 years, Intel is way down.
Yeah.
Over a longer term kind of perspective. And so you can make arguments from both sides. I think what I would say there, though, is whether or not you make an argument this way or the other, that shouldn't be the thing driving ultimately one's opinion on the stock price. What's the stake in the government? What kind of tariff rate are they going to negotiate to sell to China or not? So hopefully we can have a little bit of a stabilization around the markets and allow American companies to just compete on that level playing field.
Yeah, we saw Kalshi and Polymarket. The odds of Nvidia being the largest company in the United States by the end of the year are upwards of 60%. So the prediction markets are bullish on Nvidia. Obviously, they are currently the largest publicly traded company in the United States, and I think the prediction markets are thinking that they're going to retain that top spot through the end of the year. I know our guest Bryce, give us the head nod whenever the guest is Dr. Atkinson is ready to join us from DC.
It's an interesting stat on Nvidia, yeah, and it continues to be kind of the measuring stick against all others.
Yeah. Are you on Polymarket or Kalshi?
I follow on Kalshi.
Yeah.
Trying to find the.
So Kalshi, the first regulated prediction market in the United States that had the CFTC licenses. I think most people will be familiar with Polymarket, but Kalshi is also a competitor and provides prediction markets on any number of things. I mean, from sports to politics to culture, digital assets, Bitcoin, economics, tech and science, even like, I'm looking on their top things right here. Who's going to win the Super Bowl right now? Baltimore 13%, Buffalo at 13%. Of course, a bunch of other players. I don't see the Dallas Cowboys on that list.
Not looking good for that.
Gosh, let's see what the chances are. Probably less than 1%.
It's been interesting to see this emergence around like the prognostication for companies and their performance shifting more and more to these prediction markets, which used to be kind of like a marginal type of area of the broader culture. And then a company like Kalshi was able to really push forward the frontier of bringing it under a regulated umbrella and democratizing that to a certain aspect. It was not long ago, you had a few kind of allowable experts to give an opinion. And now you have a much broader kind of input around what the future portends for particular companies and how that's ultimately going to play out.
Well, the thing that I check it most is for interest rate decisions.
Yeah.
Right now, a cut of 25 basis points has an 86% chance in September when the Fed meets to decide that, based upon the Kalshi market. I think it's around 86% on Polymarket too. There's typically not a lot of arbitrage between those markets. And if there is, someone closes that pretty quick by buying up contracts on the platform that seems to be less advantageous. But yeah, I'm checking the Fed interest rate decisions pretty frequently. This is interesting. It's giving Fed Chairman Powell, but Fed Governor Lisa Cook only a 28% chance of departing the Fed this year.
I would have thought that'd be higher.
I would have thought it'd be higher too. I thought it'd be more about 50-50, but that's probably because the legal battle is going to take many, many months.
So Lisa Cook, of course, has been, I mean, I don't know if at this time you say it's an allegation. It's been pretty widely shown that she committed what appears to amount to mortgage fraud and claiming two different residences to be her primary residence. And most of the communications you've seen publicly have been more around the president is not allowed to move a Fed chair. Typically, I would have agreed with that because I do maintain that the independence of the Fed is an important part of the broader economy. But this is a little bit egregious. If you had just asked me, I would say maybe that's closer to 80% or above, and yet you see the prediction market show a different potential outcome. As I've watched it so often, you're proven wrong versus the broader crowd of people that are watching this closer, and it'll be interesting to see that continue to play out as it becomes kind of more and more politicized. I would have hoped that having a major appointed official appear to commit a fraud would not be something that would take a year to play out and be subject to all this kind of hemming and hawing. But it does at least make it more entertaining to see it play out on a platform, and it creates kind of a whole new frontier in financial markets more broadly.
Well, it's not that it's the people that have not the loudest opinions, because that's what we're used to in society. Is like listening to who's going to get their opinion out there the loudest, who has the most distribution and the most followers. It's the people that are the most informed. Right. And that's what you really want to see, because people who are informed will put money because they have some asymmetric knowledge that perhaps Joe Smith doesn't have, who may have a loud opinion about something but doesn't have that knowledge, and who's therefore not going to put money on it. So in Kalshi and Polymarket, you're seeing really, really helpful information. So I'm extremely bullish on prediction markets. I think we'll see how the public markets treat those two entities.
So on that, I'm gonna pivot a little more to the public markets as we wait for our speakers to potentially join us, because we went through a period not long ago where there was kind of an IPO drought, and a lot of that had to do with extreme volatility around COVID and the uncertainty with that. But then later into last year, it appeared almost like a clear policy of the prior administration to oppose major M&A, both public and private. And I think one of the kind of trend-setting IPOs that occurred recently is Figma, a company that over the years has developed a huge following that allows for design teams to collaborate across different projects, and was in the news not long ago for a big merger that they were going to go through with Adobe that was not approved by the prior administration. You had a big breakup fee from that. Ended up being, in some ways, a win for Figma, in that they got $1 billion from the breakup fee to keep the company going. And then just a few weeks ago was one of the biggest IPOs of the year that I think proved two things. First, more broadly, the IPO market is back. A lot of other companies like Canva has to be watching that very closely. But secondly, it's also shown that there's something of a danger here with kind of the initial excitement around an IPO. You saw a huge ramp up in share price, traded all the way up to $120 a share. It's down close to 70 now. Would still be a successful outcome. I mean, multi-billion-dollar IPO and rally from that. And on the heels of that, in the private markets, you've had a private competitor named Framer that recently raised $100 million at a $2 billion valuation, still smaller than Figma. That's kind of an order of magnitude bigger than that. Yeah. But it just shows the VC market is taking that signal. There's a broader opportunity to exit from investments now. Figma kind of de-risked that. And most tech companies have to really be reassessing the timeline and their strategy. And as we alluded to earlier in the show, we want to see more IPOs in America. Yeah. Sadly, I think in the story of Figma, at least, this was a very mature company when it came to IPO. Still a win for them, a win for their investors. But not long ago, they would have IPO'd way earlier. And they went through, multiple funding rounds with VCs and the private markets. And so the broader public is missing out on opportunities like that. Glad to see them in the public markets now. And hopefully it's a growth story that'll continue on, and we'll see kind of follow-on offerings from kind of cutting-edge tech company that's proving up that market.
Yeah, our team uses Figma. Billy Rogers, our VP of brand and marketing, swears by Figma. I was always a Canva person because it was easy, and I'm not like a graphic designer by any means.
Even I could figure out Canva.
Yeah, Canva's great. But Figma is a more nuanced graphic design platform that has much more functionality than say a Canva. There are some trade-offs though. Canva is more user-friendly.
That I can attest to it.
So what I would say is the reason why I would put their enterprise value higher than Canva is because just because something is easy doesn't make it's good.
Mm-hmm.
People are not producing high quality grade graphics on Canva. That's like what I go in to produce a graphic for my daughter's lemonade stand. Or we produce graphics on it all the time. I'm not saying that it's not something that you can use in a business setting, but if you're a graphic design professional, so I've been told Figma is the way and Canva is not.
Yeah, it's amazing how that in a relatively short amount of time has kind of become the standard. And it really shows, I think, the precipice that we're on here of like broad disruption of sort of the legacy SaaS providers that went through an extended period of just sort of, you had a group of, a couple of big companies that more or less were dominating the market. And then a lot of kind of startups that no one had heard about. Figma's one of these that was able to disrupt that and reach, really, they're hitting at the top levels now and are being adopted widely. Great story. Glad to hear it, and frankly, it's making me feel like I gotta start to learn how to use it myself a little bit, just because it's been on such a tear. Got another company it's a little closer to home for us. We had worked a lot in the Texas Blockchain Council on stablecoin policy.
Yeah,
and over the years, I think there's been an evolution in the mindset, at least from regulators and bankers. Not long ago, 4 or 5 years ago, certainly, I think stablecoins were viewed as almost a dirty word, something that was offshore, opaque, illicit, being used by drug traffickers and the like, which is something that had happened with cash U.S. dollars anyway before that time. But nevertheless, that image was kind of painted. First company that I think really came forward and disrupted that narrative was Circle with the USDC stablecoin. And what drove the breakthrough for Circle a couple of years ago was their alliance with Coinbase. And they were able to do a deal with Coinbase that was a real game changer and proved to be a big win for both companies. Coinbase adopted USDC as kind of the default stablecoin for their platform. And so they got a lot more traction, a lot more people depositing money there because you could hold it in a dollar denominated. You weren't beholden to a certain crypto asset that might be more volatile. On the USDC side, they got massive distribution. Coinbase is #1 exchange.
And in return, they got $9 billion from Circle. Was that quarterly? I think it was quarterly.
It's mind-boggling numbers.
Bryce, check us on that. If the $9 billion from Circle to Coinbase, I think, was a quarterly distribution that was reported on Coinbase's SEC filings a few months ago. Of course, Circle just IPO'd, so I don't think they've had their first 10Ks.
They've had the full report come out yet.
Yeah.
So this has come full circle now, where not only is the idea of a stable coin not feared by sort of the institutional players, you have a wholesale adoption. Just last month, Circle was able to IPO, and one of the banner IPOs right up there with Figma. And just to show how kind of enthusiastic the reception was from the broader ecosystem, you have a situation where this company is kind of tightly tied to Coinbase. Coinbase retains 50% of the revenues for USDC that are derived from outside of Coinbase's ecosystem. So even the broader ecosystem of USDC is paying a major kind of cash outflow to Coinbase for that distribution.
Yep.
And from the IPO, you had a point where the Circle stock was so hot, it traded up almost 700%. And in the same amount of time, you had very kind of minimal movement in the underlying Coinbase stock. So it's like a total kind of a disconnect in the market that frankly it got to a point where it didn't even really make sense. Now it's retraced some from that, but Circle is still up 300% from where it debuted.
And there was a point where it was worth more than Coinbase.
It was
or approaching.
It was approaching
the Coinbase market cap, which is crazy.
That would be firmly in the nonsensical territory.
And you know what's also nonsensical is when the interest rate, when Governor Fed Chairman Powell gave the speech at Jackson Hole that was dovish, and everyone saw, okay, they're going to cut by 25 basis points in September based upon his speech. Broad consensus on that. Circle's stock price went up along with everybody else's, but it should have gone down.
Right.
Because they make money on that spread and how much they can earn in short-term treasuries. And if they're going to be able to earn less, their stock price should have gone down. But it was like the market didn't compute that. And they just said, well, if it's in a crypto bucket, let's just let it, so it's a risk on asset. It's going to be worth more.
It's kind of disconnected and really hasn't retraced very much. And you're right. And so we can expect, I think, a continued sort of rush around this stablecoin discussion. You read constant reports around the big banks talking about launching their own stablecoins. I think what people are going to find is kind of distribution is king here.
Yeah.
The market is widely dominated by USDC and Tether. Tether's an offshore, not an American company, but is one of the largest holders of US treasuries in the world now. And so it's hard to see outside of like a JP Morgan who's going to launch their own new stable coin and be able to compete. A lot of people want to prove me wrong on that sort of line of argument because the market is so hot right now and there are so many new entrants. And I think it's a great thing, more competition, more ideas around it. At the end of the day, more of the economy is moving into a digitally native kind of position, and we want to encourage that and bring more companies to invest in that kind of technology. I think we're ready to welcome our first guest to the program.
That's right. We have Dr. Rob Atkinson here. He is the founder and CEO of Information Technology and Innovation Foundation. We're not sure if he can hear us quite yet. Dr. Atkinson, feel free to give us a thumbs up if you can hear us. Oh, he can. All right.
All right, we're in business.
I can hear you.
Dr. Atkinson, tell us a little bit about your initial impression when you saw that the federal government was taking a stake, as much as 10% stake in Intel. You live in that world. You represent a lot of the strategic microchip companies within your organization. How did that news hit you?
Yeah, first of all, clarity, we're a think tank, and so we don't have members or anything like that. We have supporters, and we're involved in the technology industry, been there for 20 years. I think you have to differentiate it between other areas where the government might make an investment out of the blue and say we want some equity in it. This was really different because this was designed by Congress, bipartisan law, the CHIPS Act, and it was designed to give incentives to chip companies, semiconductor companies like Intel, to build factories here, to build fabs. The reason they needed an incentive is it cost about 40 to 50% more to build a fab here than it does in China or Malaysia or other places like that. So we just weren't going to have any, and we got to have them in our country for national security purposes, if nothing else. So what the Trump administration did was they essentially said, well, we're going to put a condition on this. So Congress had no conditions other than we'll give you the money and you build the fab. That's the condition. Trump said, no, we're going to add one more condition, which is we're going to own 9.99% of your company. Unfortunately, that weakens Intel. It dilutes their stock. It makes it less valuable. So it was really kind of giving with one hand and taking with the other. It was kind of like a little bit like what the Biden administration did when they implemented the program. They required daycare centers. Like, give me a break, okay? These guys are running a factory building chips. You don't need to, if they run a daycare center, the company can build. So they just let the program be. So no, I didn't like it.
Yeah, we raised some concerns on the show as well around the topic of the government taking stakes in companies. It's not a very common occurrence. In fact, I can't remember the last time it happened.
Yeah.
Do you think, are other chip manufacturers or other strategic U.S. Companies now needing to go to the White House and negotiate, a stake in their company, or where do you think this goes in the long term?
I don't think it's going to happen to anybody else through the CHIPS program. Nobody else is going to go to the White House and say, hey, buy our company. We can go to the private equity markets. The CHIPS is a little different because it was a quid pro quo. The foreign companies, there's no way they're going to do that. There's no way in hell that Taiwan is going to allow TSMC to be owned 10% by the U.S. government or Samsung or any of those companies. As regard to some of the other companies, Micron and others, I don't think they're as weak. I don't think they're as desperate as Intel. Maybe they could try to do that. Maybe the administration could try to do that, but I doubt it. I think this is perhaps a one-off. Although, they're talking about it for companies like Lockheed Martin. Well, again, Lockheed Martin is tightly involved with the government. They're a government contractor. And so, but again, his history of our government, we funded defense firms. We had a contract. We gave you money, and you gave us something we need. Why put equity in there? It just distorts the whole purpose.
Yeah, I'm curious, Bryce could probably look this up for us. What percentage of Lockheed Martin's profits come from federal contracts? Do you have a sense of that? That's not as skewed for a company like Intel. Most of their, customers are compute customers. I'm sure Dell and other kind of, electronics companies are their main customers. Does the government buy a lot of Intel chips for the Department of Defense or other? Are you aware if they're a big supplier to the government?
Well, I had to guess. I'd say it's less than 3%, 2% kind of thing. It's de minimis. There are certainly fabs that are designed for military specs because you have to have a different kind of chip sometimes. But no, they're not a big customer at all. I mean, Intel's a global company. They sell to computer companies and others around the world. So no, not at all.
Yeah, and I'm just looking up here, and Bryce is flagging me that it's completely different than Lockheed Martin, where 73% of their revenue comes from the U.S. government, and 65% of that being the Department of Defense. So completely different situation.
But it's completely different. Although, again, I think the Trump administration would say, well, we're giving you money. We're giving you, I don't know how much it was, $8 billion or whatever. I don't know the exact number, to build a fab, which would cost a way lot more than that. So that was sort of the logic. But, the thing with Lockheed Martin, that doesn't make any sense for the government. Let's say a company sells the government some paper, reams of paper. Are they going to take equity in the paper company? Or, how about a little pizza parlor that, sells pizza to some federal lab, oh, no, sorry, we're going to take equity in your pizza parlor now because you sell us, $5,000 worth of pizza a year. There's no logic behind that.
Agreed.
I'm curious, since you're in DC, we've seen kind of the rollout of this announcement. Unexpected sort of argument put forth primarily by the Commerce Secretary Howard Lutnick around how this was thought through and proposed. And to some degree, it feels like there was the standard just sort of partisan reaction that you would expect from people on the other side of the aisle saying, oh, this is corruption or whatever. And then the news cycle kind of moves on to the next thing. I'm curious, is just within your work in DC, has there been an emergence maybe within the Republican Party broadly or from other interested groups to say, hey, this is an issue that we should continue to discuss, have more follow-up? It's more nuanced than I'm for it or against it. Or is this more of a sort of, it's happened, the deal's done, this was a one-off, maybe Lockheed gets it, but like this isn't news anymore? It felt like a pretty monumental shift to us. And we're curious for your take around what does a dialogue look like going forward here? Or is it more of an effort to sort of not have a dialogue?
A couple of things. One is, on this issue and so many other related to economics, trade, technology. Lots and lots of Democrats who were just opposed. I say this, by the way, in a nonpartisan sense. Lots and lots of Democrats, whatever Trump's doing, we're opposed to it.
It's bad. No matter
And
what.
then within the Republican Party, you really do have a split on this issue, which is, traditional, more free market Republicans look at this with a lot of concern, whereas more Trumpian Republicans, advanced Republicans look at it as, no, this is part of, Make America Great and all of that. I think in this particular case, I think the corruption argument is just, I don't buy that. It's non-voting stock. I think really one of the reasons the administration did it is they're just looking under the cushions of this couch for extra pennies and nickels to, fix the deficit. They get a little bit of equity here. It offsets the balance sheet. I think that's part of what they're doing here, because they did pass the big, beautiful bill, which was a pretty big tax cut, and it is going to increase the deficit. So, they've been doing things like that. Like, for example, the NVIDIA approval of selling some certain types of chips, not the best chips, but secondary chips to China. They said, well, you got to pay us extra money. So I think they're kind of looking around for other ways to raise revenue. I think that's really more it. I think this issue will continue if the administration keeps going forward. They say they gave some signals they might, but for now, I think it's more a little bit in the background while people are sort of wait and see kind of situation.
I got another question for you that turns a little bit more technical. What do you think is going to be the smallest chip size to be manufactured within the United States by Samsung or TSMC? Are we going to get 3 nanometer chips manufactured in the United States anytime soon?
So my guy who leads our semiconductor work, Stephen Izell, would know that better than I would. But my sense is that they are going to be, particularly TSMC, going to be building advanced node chips in the U.S. It may not be quite as advanced as the leading edge in say, Taiwan, but it's going to be pretty advanced. So I think we'll get that.
And that's the Arizona facility?
I think the CHIPS Act overall, if it's employed right, we'll see a lot more chip production in the U.S. I think the big question really is Intel. One of the misleading notions that a lot of people have had about this program is it's a subsidy program. It's not a subsidy program. Intel is not going to make a dime off this program because their costs are so much higher. We're going to remember that if Intel were just rational, they wouldn't build a fab here. TSMC wouldn't build a fab, or they'd build it over in Asia where it's so much cheaper. So I think that's the other big question is, how strong is Intel going to be, and if they were to really suffer, what do we do about that? Because we don't then have a major logic chip maker.
Yeah. And in your work within the Information Technology and Innovation Foundation, I'm curious, as we kind of look at the broader innovation landscape, the government's involvement in that, putting their thumbs on the scale to help or lift up certain companies, what's your priority area and kind of the short to medium term of what's kind of the next thing up that you're maybe working on that you think is more salient than maybe other issues? I'd just be curious for your opinion. Kind of, you get up in the morning, something's kind of got your attention in DC. What would you say that is?
Well, for me, I'm kind of like ADD hyper-focused on one thing, and that's the China technology industry threat.
Yeah.
I think we underestimate in Washington just how advanced they are, how much progress they're making, and not just on cutting-edge things like quantum communications or AI, but other areas like machine tools and robotics and chemicals. I mean, we've done a whole series of work on that, and I really, really worry that unless we work together with our allies, unless we really seriously start to block a lot of unfairly made Chinese imports. I'm not talking about blocking everything, but unfairly made. I worry that we're going to lose a lot of our advanced industry capabilities, and that's going to really make it hard for us to be a national power, an international power. I mean, if you look at what the president tried to do with China, I was like cheering. I was like, man, this is great, way to go, because he basically threatened to block their big, giant, unfairly, state-owned enterprise Comac, which is like a Boeing or an Airbus. Totally illegitimate company, massively subsidized, forced these foreign companies to provide them technology, guaranteed sales in China, and their Achilles heel is engines. They can't make engines, and so Trump said, we're going to block engines. Like, oh, this is beautiful, man, this is beautiful. And the Chinese said, well, if you do that, we're going to block rare earths. Yeah. So we had to back down. So a lot of this is about power. We can't let the Chinese have leverage over us to basically say, hey, if you don't do this, we're going to cut off your ventilators or your masks or your whatever it is now. So that's what I worry about. That's what I think about.
Yeah, I'd say I worry about it too. It's been disturbing for me to see really a leadership position staked out by Chinese companies in the open source ecosystem. Most of the state-of-the-art kind of cutting-edge models in the U.S. have leaned towards large private companies that keep them closed for themselves. There's an argument both ways as to what's the better path to market, but certainly if you zoom out for kind of global adoption and somebody's given an option that's open source they can build on top of, or one that's closed source, and they don't have an affinity of whether it's Chinese or American or whatnot, I struggle to see how a lot of like the global kind of tech stack that emerges doesn't migrate towards something that has an open source component to it. So I'm hopeful, and in the recent kind of AI plan that the Trump administration laid out, credit to them, they very clearly pointed that out, that there's a deficiency there in the U.S. strategy. China's really leaning into that area, and I'm hopeful we'll see more headlines and discussion around that, and that the U.S. can lead in both closed and open source, and there's a time and a place for that. But I do agree with you that the age of kind of saying, well, China's just behind, and it's kind of this marginal threat, and there's an inevitability to the U.S. emerging here. It's far from inevitable, and in fact, a lot of the evidence points towards a pretty worrisome outlook if there's not a material urgency really across the U.S. economy to lead in technology. I think to your point, we're starting to take steps in the right direction there, but it's an ongoing discussion, and maybe that's part of what we're doing with this Intel investment is you got to try new things, do different ways to stimulate innovation, and what we were doing before wasn't really working. So I can at least at a minimum embrace that.
Yeah, it's not that it's, I don't think we should look at it like, oh my God, this is immediately horrible, because we do need to embrace new ways. But to your point, like, we're not taking this challenge seriously. If we were taking the challenge seriously, we do several easy things. One is we would have raised the research and development tax credit that companies get. China's research and development tax credit is 3.7 times more generous than ours. Wow, second, we would have radically reformed, or in my opinion, eliminate NEPA. I mean, we can't afford, and NEPA is the National Environmental Policy Act, and it just bogs things down left and right. Everybody knows that. I mean, I looked at one project in Pennsylvania. They're building an 11-mile road, and the NEPA reports were over 1,400 pages.
Wow.
But come on, man. It's not out in the wilderness. We could easily do that. There's just all these other little things we could do that suggest. There's another good example. We have a trade law that's for a number of different trade remedies that you legally can get against unfair practices from foreign companies. They stole your IP and they're selling in this market. They're selling way below cost because they're subsidized by the government. Under our law, which was established back in the 70s for this, you can't win the case unless you show that you've been harmed. There's so many cases where the Chinese are coming in and taking growth of markets. So the American companies is stable. They're not growing, they're not declining, although they will decline. And they can't get any help, even though it's clear that the company has been, their IP, their intellectual property has been stolen. That's a simple fix Congress could make tomorrow with no cost, zero. And so that's my point. To your point, we're not taking this seriously enough. There's easy things we could do We have another program, one last thing. We have another program called the Development Finance Corporation. Very good program. The President Trump supported it being reestablished. You know, half of the programs it funds are in countries that are on what's called the 301 watch list. This is a list by the United States Trade Representative Office, who steal our intellectual property. Why are we giving them help? Why are we giving them help? It's crazy. So one of the great things about the Trump administration is they're working on these things, but they got to do more, and Congress needs to, take the lead as well on these things.
That's great insights, Dr. Atkinson. We appreciate you joining us again. This is Dr. Robert Atkinson, heads up the Information Technology and Innovation Foundation in Washington, D.C. Thanks for being with us this morning.
Thank you for joining us.
Hey, my pleasure. Thank you.
3.7 times larger.
Yeah.
The Chinese research and development tax credit is 3.7 times larger than the United States.
It's back to your comment before around part of the reason, even if you don't like a government involvement in the private sector, is just the total uneven playing field. I myself spent a few years in Washington, D.C. I worked on some international finance projects, and at that time, and it ebbs and flows by different countries, but at that time, the export financing that the Korean government was giving to a lot of their national industries, and that's how you end up with a Samsung, was so aggressive that there was a big push around, we have to match that, but it's really not the American way. And so we're trying to find a path forward there. But you hear that kind of number 3.7 times, and you say we have to reassess this. Good testimony from Dr. Atkinson there, and I wish him well in his work.
I'll mention
forward.
one thing on this as well. We're talking about when it comes to the Chinese competing with us. One of the biggest sort of rebuttals to that is, well, they have a demographic problem. And that's certainly true. One of the bigger issues there is, though, that with AI, that makes it a lot less relevant.
That's true.
Because in 2 years, companies are going to buy more GPUs, not people.
Yeah.
So, people are saying, well, they don't have the workforce for it, or they don't have, or at least they have the demographic problem with the real estate being in a bubble. That's true, but when GPUs mean more than people in the coming world, does that really matter? And it's not going to.
Yeah, and it well said, Bryce, and it reaffirms kind of the point of why it's so important to maintain GPU supremacy in the United States. So it's something that we'll probably be talking about a lot more,
Yep.
and we'll be doing so at the TexCap conference as well.
And now we've got a little bit of a pivot to talk about policy here in the great state of Texas with regard to Senate Bill 2337.
Yeah, and I think taking a step back, I've heard the question asked. There's kind of like the headline grabbing clickbait, if I can call it that, of there's going to be a stock exchange in Texas now. Then the New York exchanges come here. I think a lot of people say, why? What is the point, right? If all these exchanges are fully electronic now, what does it matter if it's New York, if it's Texas, if it's wherever else? And that kind of skepticism, I think, is fair. But what we'd like to highlight today is it does matter. And I think this law is really an excellent example of that. Senate Bill 2337 passed in the most recent legislative session that ended just a few months ago. These laws would go into effect September 1st, so just 2 days ago. This one, however, has an injunction due to an ongoing lawsuit. And that's why we think it's kind of an inflection point here in this discussion around what is the role of government regulation of different jurisdictions, and what does that mean for investors and for issuers. This one particularly is dealing with proxy recommendations and the entities that oversee that, which is dominated by two entities, Glass Lewis and Institutional Shareholder Services, ISS. And so you have kind of a de facto oligopoly where when people invest in these passive vehicles, you own shares. I have some in my 401k of whatever companies are in there. They go to these proxy advisors. A lot of times they end up making recommendations in terms of voting shares, and people don't have disclosure of what's going into that, what's driving it. And more recently, we've seen more and more non-financial considerations whether it be diversity initiatives or environmental concerns. As we were just saying, some of these environmental issues are extremely restrictive to businesses. And you see proxy shares by these entities often being voted in a way that is likely out of touch with a lot of the interests of the people that actually own those shares.
Yeah.
The nature of this law is simply to say we need enhanced disclosures and transparency around what's driving these recommendations. Why are you voting a certain way? It used to be kind of self-explanatory or assumed. Well, you're voting in the best interest of the financial outcome of the shareholders at large. I think we've seen a divergence in recent years away from that.
Yeah, I think we have. And that's why the Texas Association of Business and the Texas Stock Exchange are pushing back against ISS and their co-litigants. I'd never heard of this firm, Glass and Lewis.
I'll admit I hadn't heard of either one, and it's one of these things I'd wanted to look up. Like I said, I probably own some shares in a company. I haven't taken the time to go and vote those shares that one of these entities probably oversees. So it's been interesting to see that.
Well, and we brought in some legal firepower. Chris Davis, who's the co-chair of the Digital Assets Department and a former SEC litigator, current partner at Gray Reed, a great Dallas-based firm, who understands this topic. In fact, one of his partners, or I guess his one of the other partners at the firm, who was one of the authors, the House side author for Senate Bill 2337, Jeff Leach, and he's a partner there at Gray Reed as well. So, Chris is coming on. He's coming to us from, I believe, Austin, Texas. But Chris is always a wealth of knowledge on these kinds of topics. Chris, are you able to hear us okay?
You're just fine.
Well, thanks for joining us and taking some time out of your day to talk about this transparency initiative that is being stymied by the litigants, Glass Lewis, and then Institutional Shareholder Services. You've done a lot of work with kind of in the capital markets in general, but specifically around this kind of litigation. How did this hit you when you first read about this case?
Yeah. So this one's tricky, right? This is something that the SEC in particular has been trying to regulate for years. There was actually a decision out of the DC circuit in May in which they kind of got their wings clipped a little bit. They were trying to regulate this through the solicitation rules that the SEC has. This was kind of Texas's effort at the state level where federal legislation and federal regulation had failed to do this at the state level. So I was not surprised to see litigation filed on it, right? This is a brand new area. It had never been regulated before. The state in its legislature was requiring disclosures that had not been required before. Plus, this is aimed at, a couple of very powerful entities within the financial industry. So I was not surprised to see that this was challenged based on the novelty of it and the, and kind of the power of the entities this was aimed at, namely ISS and Glass Lewis.
And Chris, help us understand kind of how this plays out in terms of jurisdiction. I believe that the defendant here is the Attorney General Ken Paxton, who oversees the enforcement of the law, and this case would begin in the Texas courts and potentially be appealed up from there. Or what does that look like in terms of the path forward and the timeline here? The law would have gone into effect just a few days ago. There is an injunction now, so it's not in effect. Is this in limbo for years? How does that look as we see the Texas Stock Exchange and other associations getting involved in this process?
Yeah, I think one question is what's going to happen next. So as you mentioned, the Attorney General has the power to enforce the law. There's also a private right of action conferred by the law, which I think is a little bit up in the air at this point. I think one question is what the next move will be. The AG's office could actually go and ask the Fifth Circuit to stay enforcement of the district court's order while this continues to play out and while they prepare an appeal, because one would expect the state to immediately appeal this to the Fifth Circuit
Right.
as quickly as possible. And then the Fifth Circuit's going to have to, of course, decide what to do with that appeal. At the district court, let's assume that happens, and I think you're going to see a fairly fast track to the Fifth Circuit, which will decide these issues, maybe even the Supreme Court. This is the kind of case I would not be a bit surprised if it made it to the Supreme Court in light of the novelty, some of the issues that are in play here, constitutional issues. I mean, obviously the defendants have raised a couple of issues. They've raised the free speech issue, and they're saying the state is compelling us to make statements that we don't agree with. And then they're also raising conflicts with federal laws like ERISA and the Investment Advisors Act of 1940. Those things are kind of right there for consideration by, courts of appeal or even the Supreme Court. Now, assuming it proceeded through the district court, as we sit here today, trial is set for February. This is not the type of case to where I would expect there to be a whole lot of discovery, right? I mean, I would expect this to proceed on a bench trial decided by Judge Albright. These are largely legal issues. He would be able to decide as the judge whether there are, the constitutional issues here are valid. I mean, he's preliminarily determined that to be the case, right? Which is why he issued the injunction. But he would make a final judgment. He'd hear other evidence. He'd hear from other people who have a stake in this thing, right? Like the interveners, the Texas Stock Exchange and Texas Association of Businesses. So I don't think this is something that's going to be hanging out there for years, at least to get a decision, an initial decision. But then when you factor in appeals, would those appeals actually stay the law while they go forward and all those other sorts of things? That could drag on for years.
Interesting. So the next domino to drop would be in February there. And, another thing I haven't looked into much, we're highlighting in terms of the, on the side supporting the implementation of the law, the Texas Stock Exchange and Texas Association of Business. I haven't seen as much what groups are going to come up. I suspect, as you highlight, if this gets appealed and kind of continues to go high profile, you're going to see more and more groups on both sides start to bring in all these different opinions of what the implications of this could be. Because we're kind of early innings here leading up to February. I'm curious if you can expand a bit on the private right of action. The listeners may not be entirely familiar with the concept and how you sort of have, you have parallel avenues almost here. You have the Attorney General and then also the broader public. This one seems like something in terms of a private right of action could be pretty material because you're talking about public companies with, very widely earned securities. So it would seem, in my estimation, that the implications of that here would be much higher stakes than maybe a typical private right of action in any other law, really.
I think that's right. So this one was modeled after what you've seen in some other laws. A lot of people might be familiar with the Deceptive Trade Practices Act, which is probably the most well-known consumer protection statute in the state of Texas. And it pretty much, it's a model law that's been implemented in just about every state across the country. But what it does is it is enforceable both by the state to protect its consumers and the public interest that the state has in having its consumers protected, but it's also enforceable by those individual consumers. So people who are harmed by a misleading statement made by a business, just as a general DTPA matter. Now, what they did here was they said if these proxy advisors don't make the disclosures required by the statute, which they're required to make certain disclosures if they make a recommendation that's based upon non-financial measures. And the statute specifically mentions ESG, DEI, and sustainability scores and things like that people might consider to be a little bit squishier. And they said if you don't make this disclosure, it is a deceptive trade practice, and that there's a private right of enforcement. So that the people affected by that disclosure could be the companies. It would actually be interesting to see what plaintiffs might try to bring that type of action. Would it be a company? Would it be its officers? Would it be its shareholders? That would all have to play out in court, to be honest. That comes down to who's got standing. But it explicitly created a private right of action under the law. And so, to your point, a company that has one of these shareholder proposals, and of course these things have become prevalent in recent years. The kind of activist shareholder proposals everybody remembers. Exxon, the engine number one deal, that was probably the most well-known one of those. But as they become prevalent, companies that believe that they're harmed by the advice given by these proxies advisors, or that they're not making the proper disclosures, could then turn around and sue them. And the damages under the DTPA can get very high, because there's statutory damages for each instance. And so depending upon how a court views that, is each time a shareholder reads that advice, is that a separate violation, right? Or is the one-time publication a violation? It also allows, maybe more importantly, those companies to seek injunctive relief and declaratory relief, so that they could potentially have a court order these proxy advisors to do something, right? Which was a big part of that. Some of these companies that may be more important than the statutory penalties. So long and the short of it is, I think your point's right. I mean, it could be a powerful remedy. I mentioned on the one side, you've got these proxy advisors that are very powerful. On the other side, you've got publicly traded entities that have a lot of skin in the game themselves, that are also powerful and can afford expensive lawyers. So that's how that would probably play out.
And I think it's worth highlighting for the viewers that the debate here, the enforcement of the law is focused on disclosures. It's not saying we're banning that you can make, that as a proxy advisor, you can do X, Y, or Z. The focus here is about just increasing transparency and saying, hey, you should at least have to tell people we're including under consideration things that are of a non-financial nature to make a financial decision. Seems pretty reasonable to me, at least. It's remarkable to see the stakes so high, and really an effort here to basically say, investors should be in the dark. Proxy advisor will just kind of decide what they're going to do. I can see how many more people will be weighing in and probably filing amicus briefs and all kinds of opinions, because almost everybody in the investment space could be impacted by this sort of influence. And hopefully this can be, as you kind of pointed out, a remedy to reorient the discussion back to running the company in a way that delivers value to shareholders, as opposed to these kind of various and different other external factors that at least appear to have been under consideration. Because I would say you wouldn't be going into a litigious kind of approach to this if you hadn't been doing that. That's at least my take on it. I'll say though, I am curious. So you said we've got the next kind of court will be taking this up in February. You said you expected a fairly simple discovery. As this appeal process goes on, could that process really be a way to kind of force this oligopoly of Glass Lewis and ISS to go through a process to reveal sort of to what degree were they incorporating different, whatever you want to call it, environmental or sustainability or whatever it is, into prior recommendations? Because I'm almost inclined to go and look at, what are the different votes that have been taken recently? I'd like to see different examples. It seems like the case itself may be a way to tease out, well, look at this way that certain shares were voted. Does this seem reasonable or not? I'm just interested to see that play out. And I'm wondering if you expect that sort of, headline type grabbing stuff, it seems could be a part of this case in the coming months and even years.
I think that's right, and I'll tell you why I think it's right. For instance, Glass Lewis wrote a letter to the legislature, I believe it was back in March when this bill was being considered, and they made the same arguments in court, which is that you're forcing us to say things that are not true. For instance, one of the disclosures that's required under the law says if you're basing your advice on non-financial factors, you're required to disclose that fact along with the fact that that you're sacrificing investment returns in order to promote one or more non-financial factors. And so they've said, we don't actually believe that to be true because we don't believe those two things are mutually exclusive. We believe, they use the example of, on the environmental side, the cost of oil spills. And they've said, we think that there are plenty of instances where these things marry up. They use the example of the fact that they've got Catholic clients because there's also disclosures that you have to make if you give one client different advice than another client. So we may give a Catholic client different advice than we would give, a non-Catholic or a non-religious client, because they've got different mandates that they give us when they hire us. Well, so they put those things squarely at issue. So I would fully expect that, to the extent that there is discovery, they would look at those things and say, what they're saying true, right? Is it true that they're looking at, harder to quantify financial factors that are nonetheless important to the bottom line, for lack of a better word, right? Like, to use the environmental example, I think they would be put to the test on those things on discovery. So like I said, I think your point's exactly right, because I think the companies themselves have put those issues squarely front and center, right? And so I think on discovery, you would definitely see that stuff played out.
This case has gotten more interesting to me just in this this discussion. So I'm glad that we did it, and I haven't had a chance, and I'm curious if you have, Chris. I think that this issue has cropped up in a few other states. So we're a little bit Texas centric because we do live here, but the implications are obviously national here. I'm wondering to what extent. I think my question is, do you feel like Texas is going it alone here? Or I get a sense this is probably a broader movement, and we're going to see more AGs, other states, get involved, and the kind of the list of interested parties will only grow and grow and grow. And maybe as this law struggles in a certain way, or a lawsuit is able to sort of poke holes in it, another state would be able to take that as instructive in terms of crafting their own legislation to address these very valid concerns around what are these proxy advisors doing, and can we just have enhanced transparency? I think that's really the idea behind the bill here. We've been focused on Texas, but have you seen in your practice, have you seen kind of other states sort of trend setting, and or do you expect this to be sort of a roadmap for more states? Because it seems like at the federal level, it's difficult to, frankly, to pass really anything. So the states seem to be kind of in the driver's seat here.
Yeah, so I haven't been able to look at other states, so I'm gonna plead ignorance on that one. But I would tell you that I would not be surprised if this becomes some kind of a trend-setting thing. Not just the caveat there being, some of these other states may see what happens in Texas and kind of what happens with this law, and if it's struck down entirely, or maybe it's tweaked, right? Like, I can actually see a scenario where I read the law, and as a lawyer, parts of this thing, like the compelled disclosure XYZ, seems pretty more problematic, as opposed to you've just got to pull the curtain back more on why you made the recommendation you made. What financial factors did you consider? What non-financial factors did you consider? Kind of more matter of fact, right? Not having to say, these things are going to harm you, the shareholders, if you don't believe it. I can see why a court might find that to be potentially problematic. I can also, the states you mentioned earlier, amicus briefs, I can see them potentially participating here as amici, and as a way to kind of set forth a roadmap for how they could carry these things back home, yeah, and implement them in their own states. And like you mentioned, the national level has been problematic. I mean, the SEC tried to do it through regulations. I think you're right. I think there's a very probability that this is going to happen through legislation up on Capitol Hill in DC, which is where something like this should really happen. And I don't know that the SEC is going to be inclined to go back to the table on regulation.
Right. Chris, I know you're really busy. Gray Reed's doing a lot in kind of the capital markets and investment space broadly. So before we wrap up, wanted to give you a chance. Sounds like you're down in Austin right now. You're getting around. You're involved in a lot of things. Just wanted to give you a chance to maybe highlight something you're working on, or you've seen recently, or that's on the docket coming up that you think the viewership might benefit from, or just be aware in terms of kind of the subject matter expertise and leadership that that y'all have there at Gray Reed.
You bet. Well, thanks for teeing that up. We're full service. We do everything, as you and Lee know from our prior experiences. We do a lot, not only in kind of the the more traditional securities and capital market space, but we've done a lot in the cryptocurrency space. And frankly, we really just enjoy exploring these new areas of the law and talking about things like we're talking about today, which are, I think intellectually stimulating, but importantly, they kind of chart the path forward, right? With all the exciting stuff that's going on, and from financial services perspective, fintech, crypto, I mean, you name it, right? It's a pretty cool place to live and a pretty cool place to do business. So we got our hands in all it and love to help tackle new and uncharted waters.
Well, look, I appreciate your time. It's clear to me we have not heard the last on this Senate Bill 2337. There'll be many more chapters in this, and it really is high stakes. We're thankful to have your perspective on it, Chris. Appreciate you coming on, man.
Thanks for having me.
We neglected in the intro to Chris, since he was mentioning there, our prior experience with him in the Texas Blockchain Council. You may care to shed light on it, but we've done a lot of work in Bitcoin mining. It used to be almost kind of an untouchable thing. Now it's very much in the fairway in the capital markets with the AI rollout. But the industry was experiencing really very fair treatment from the federal government in terms of forcing all kinds of unwarranted and unneeded disclosures, and really intrusive. And with Chris's help, we were able to be part of litigation that was able to put an end to that. And so I highlight it not just in terms of our friendship and prior work with Chris, but to highlight that these cases and the way they play out in the courts can often be just as important as the underlying law itself. And so you really do have to watch that, and you benefit from having that kind of inside knowledge in terms of what the implications of that can be.
Yeah, we were in front of Judge Albright, who was the same judge that Chris just mentioned.
The very same judge.
Very same judge at the federal, Central Texas Federal District Court. And within a matter of 12 or 14 days, I can't remember, one of the two, the legal team was able to rebuff the Department of Justice in that suit against the Office of Management and Budget and the Department of Energy related to some Biden era and really Elizabeth Warren directed pressure against the Bitcoin mining industry with some, trying to compel some disclosures that would have compelled disclosure of competitive information and all kinds of things that they weren't compelling from other companies. And so it was quite discriminatory. Speaking of Bitcoin, I know we've got our friend Grant Switzer in the waiting room. He is a former partner at PwC, did quite a bit of work at PwC related to energy and audit and tax and things of that nature and consulting. And he's got an exciting new venture to talk about. But in general, he's going to share his perspective about a trend that's been taking over public markets, which is the digital asset treasury companies. Bitcoin treasury companies have been springing up left and right for the last 9 months or so. Of course, MicroStrategy, now Strategy, being the originator of this concept for many years now. Yeah. And there's a lot of copycats. And it's a unique situation in which the copycat is not a competitor. They are almost building blocks upon each other. Yeah. Because they're holding a finite resource, and the more treasury companies that exist, the higher their stock price is going to go, because there's fewer and fewer fewer and fewer Bitcoin, more and more dollars chasing fewer and fewer Bitcoin. So we have Grant Switzer joining us from Dallas, Texas. Grant, thanks for coming on to Texas Capital Live. We'd love to get your insights on this emerging trend in digital asset treasury companies, and in particular, anything you can share about what you're doing in that space.
Thanks, Lee. Yeah, I appreciate it. Yeah, I'd be happy to talk about one of the things we have going. But yeah, just in general, there's a lot of capital market activity with the Bitcoin treasuries. A lot lined up to go through their initial funding IPOs. A lot of capital. It's estimated to be about in the aggregate by the end of 2026, it's 300 to 400 billion that would go into these Bitcoin treasury companies. So it's quite a trend. There's still a lot of confusion about it, especially around how to value it. There's been a lot of short interest In particular, Jim Chanos has spoken out a lot, and he has a well-known position, shorting the Bitcoin treasuries and buying Bitcoin. But it really raises some questions just on how some of these should be valued. And I think we're just so early. We're early in Bitcoin. We're even earlier in the Bitcoin treasuries. So I think it's going to take some time for the markets to really understand, the value of these. There seems to be a misunderstanding that it's more like an asset management, like an ETF. And some of the traditional finance would talk about, we expected the Bitcoin treasury companies to really take off after ETFs were approved because now the investors had another option. But the purpose is different. I mean, as you said, Lee, and it's much different to hold this within a C Corp and just the optionality that's available to companies with their stack of Bitcoin. But the one thing that we're working on, and I'm working on a transaction with a very talented group from Next Layer Capital, but I'm told I can't give many specifics about it. So maybe talk a little bit just about the objectives and kind of how we're looking at some of the challenges that some of these other Bitcoin treasury companies have had, and how to address that. But the short of it is the objective would be combining a Bitcoin treasury company with a permanent capital vehicle like a Berkshire Hathaway, right? So the idea is accumulating both Bitcoin and buying operating businesses, not selling either one. These are long-term hold, really forever hold of businesses that are cash generating, enduring, mostly American businesses, and combining that with a Bitcoin treasury. And we see a lot of opportunities on the business side for acquiring businesses where you have private equity exits have been declining. They're lower. We're going through this great wealth transfer, as they call it, 80 trillion being handed down from baby boomers to the younger generations. A lot of that wealth is in the form of family businesses. So the traditional exit for a family business might be selling to private equity or to a strategic, but this would provide a third option of a permanent capital vehicle with Bitcoin on the balance sheet. So excited about that. Of course, it's going to employ a lot of Americans too. So we like that aspect of it.
Grant,
a lot of the companies that, if you look at strategy, really started with issuing the ATMs at the market stock offerings, which now that they have moved into issuing a lot of the preferreds with a coupon. And we like the idea of having cash generating businesses to cover the coupons rather than issuing additional equity to the idea is really focused on the downturn. So building a model that provides a lot more optionality in the downturn. So when capital markets are closed, or the MNAV, the multiple of net asset value, which is one of the key metrics for a Bitcoin treasury, if that's at or below 1, the opportunity to raise capital and buy Bitcoin would be very limited. So having these other cash flowing businesses just provides this optionality to borrow against the business, really bringing some of the cash flows forward to borrow to buy Bitcoin. And that can lead to the more consistent stacking of Bitcoin really in any type of market. And we're also building with the idea that there'll probably be distressed opportunities down the road when we do have a downturn. So we've added, restructuring expertise and turnaround expertise. Another thing we've been focused on is really building this institutional grade management team and board. So we have M&A bankers, a lot of private equity experience, restructuring. There's industry expertise across several verticals. So just excited about just the institutional grade of this venture. So that's probably about all I could say, but happy to go into any other topics, or we get into the Bitcoin treasuries more generally.
Well, I do have a question
Yeah.
about MNAV.
Yeah.
I've read about this several times, and I think the viewers and myself included are not experts on how the MNAV works. So, if you wouldn't mind just sharing a little bit of a description of how MNAV works, specifically related to Bitcoin treasury companies, that'd be great.
Yeah, sure. So the MNAV, it's a multiple of net asset value, right? And a lot of these metrics were developed by MicroStrategy, now Strategy. MNAV is just a multiple of the market cap to the underlying Bitcoin, right? So if the market cap is twice the value of the underlying Bitcoin, that's a MNAV of 2. And this has been just a popular metric that they're using, and the higher the multiple generally means the faster the company is able to accrete more Bitcoin per share, right? So it's like a growth company. So growth companies trade at much higher multiples. Same thing in the Bitcoin treasury. If they're able through this using their higher MNAV to using the elevated stock price to buy additional Bitcoin, which is accretive to the existing shareholders. So it's the faster a company can accrete this Bitcoin per share, the higher multiple they would trade at to their underlying net asset value.
So which company has the highest MNAV right now? Is it still Strategy? Or I know their MNAV has been declining slightly.
Yes, Strategies has come down. It's probably in the 1.7 range now. It got as high as about 3. But the fastest one, Metaplanet, it's the smaller ones that are accumulating Bitcoin very quickly, and so that increase in the Bitcoin per share is substantial. It might be, it could be 100% a year or something in the early days. So those might trade at 6 or 8 times MNAV.
Is that just is that a
of course
function
the
of their
scale? The
Yeah.
larger you are, the harder it is to do that.
Got
right.
it.
So
and talk about
yeah.
with Metaplanet, there's a tax advantage there for Japanese investors.
Sure. Yeah, they it's and that's the idea with a lot of these Bitcoin treasuries that are being spun up in different countries is the regulatory capture, right? So if capital is limited in where how they can access Bitcoin, it's creating the vehicles to access Bitcoin. And in Japan, the Bitcoin itself is taxed unfavorably, but Bitcoin companies are not. So this is a regulatory arbitrage where it's very popular in Japan to buy the Bitcoin treasury because of the tax advantage over owning the spot Bitcoin. And same thing is occurring in different countries. There are many the whole idea of the Bitcoin treasuries is to securitize Bitcoin, right? So they're pool of the 900 trillion in assets, debt, equity. Most of that is fixed income market, real estate. A lot of it is not able to access and get Bitcoin exposure. So that's the business of a Bitcoin treasury is securitizing Bitcoin. So looking at the demand, where's the demand for the instruments? Is it equity? Is it fixed income, preferreds? But really meeting the demand, that's what Michael Saylor's focus on his strategy, is meeting the demand in the capital markets for Bitcoin exposure.
And the biggest risk with the Bitcoin treasury companies when they're offering in some of these preferred shares, they're offering some yield and returns.
Right.
The biggest risk is they would have to take on debt to pay those returns or sell Bitcoin to pay those returns at some point. Not now, but if the market turns against them, that's a potential. Is that correct?
Yeah. Well, what's interesting is Strategy has. They're not taking on debt to pay the coupon, and they're not selling Bitcoin. Instead, they're issuing more equity
and just using that cash to pay the coupon.
Yeah, raising money by issuing equity to pay the coupon. Now they have some cash flows. It's a pretty small business from their technology business. It won't cover the coupon payment, not close, but it's just continued dilution of the common shares to issue the equity to pay the coupon.
And if you're a common shareholder, it sounds like it's not good. But if you think long term, you're realizing that your shares have all this Bitcoin behind it, and all these preferred shares are increasing your Bitcoin per share in the long run,
Right.
even though you're getting diluted in the short run. How do you think about that?
Right. Yeah. I mean, the long term. So in the short term, there is a lot of supply of the equity, right? Of these ATMs, the additional capital raise and the dilution. But over the long term, all the excess value in the business will accrue to the common shareholders.
Yeah.
Right. The preferred would be paid back the face amounts. So the appreciation of the Bitcoin or whatever that Bitcoin may be used for in the future, that excess value will accrue to the common shareholder. So it's really not to the disadvantage of the common shareholders to issue the additional shares to pay for the coupon, as long as Bitcoin's return outpaces the coupon. Right. Over the long run, the common shareholders would benefit, but it's a lot of supply. That's where Jim Chanos comes. His theory, a lot of is how much supply of Bitcoin treasuries is being in the market. He says he calls it the Bitcoin treasury paradox, in that a Bitcoiner is buying something that has an infinite supply, as opposed to the finite supply. So strategy is buying Bitcoin and selling their shares, right? So they're buying the limited supply Bitcoin, but just continuing to issue shares. And he talks about the Me Too companies that have come out. So a lot of copycat of the Bitcoin treasury strategy. And that's where I was getting at. There's probably 300 to 400 billion in the aggregate that's being raised through the end of next year. So he just thinks that is too much supply for the markets to absorb. And 400 billion, it's a big number. If you look back in the SPAC date, 2020, 2021, when the SPACs were really hot, I mean, they raised about 250 billion. So it is substantial. It's a lot for the markets to absorb. But the counter to that is the other side of the trade is buying Bitcoin, right? So yes, you're issuing additional shares, but it's being used to purchase Bitcoin, and that, with some other tailwinds, with regulatory clarity and other tailwinds, should be good for the price of Bitcoin. And when price tends to start moving with some volatility, then these Bitcoin treasuries do better. The MNAVs expand. So it was interesting. There was an excellent debate between Pierre Rochard and Jim Chanos, hosted by Preston Pysh. And those two, they should be commended for, it's one of the most professionally done. The way they disagreed was so respectful and professional. So really shout out to that. That's how a debate should be done. But it was interesting that they agreed on so much, even to the point of, yes, there are a lot of Bitcoin, there are a lot of copycats, and there's a lot of capital that's going to come to the market. But they interpreted what will happen differently, with Jim Chanos saying, well, that's too much supply. You have this infinite supply of equity. I'd rather be on the other side of the trade of buying the finite supply of Bitcoin, where, Pierre is saying, well, but the purchase of all that Bitcoin, along with other tailwinds, should be good for the price of Bitcoin, which is good for Bitcoin treasury companies. So it's very interesting, but that was my takeaway, was it came down to interpretation of the impact in the market of all this new fundraising around Bitcoin treasuries.
That's fascinating. Chanos almost got liquidated, didn't he, early on? I mean, with all the shorts he had on MicroStrategy. I guess he's doing a little bit better in the last 2 or 3 months. Yeah.
Yeah, I think that trade has worked okay for him. MicroStrategy has come down. I mean, the Bitcoin treasuries have, the MNAVs have compressed some lately.
Right.
Yeah.
So
but still higher than one.
Maybe a good short-term trade.
Grant, you spent a long time in kind of the traditional finance, kind of legacy finance world. I think it feels like you kind of got a front row seat here to this transition of I'm a former banker myself, and Bitcoin used to be kind of like a dirty word in the traditional banking world.
Exactly.
It feels like we're moving into a bold new era. As you mentioned with the MNAV compression, maybe the initial sort of excitement is settling into some new normal. My question for you is just, how have the conversations gone with a lot of the, traditional players, investment firms that just a few years ago would have like hard pass on something like this, and then maybe
Yeah.
going through a process of saying, not only does this make sense, but maybe we want to lean into it. Just, can you shed any color on like living through that? What have you learned? What are you hearing as you meet with people and we go through this transition?
Yeah. Well, I left a little over a year ago, left the Big Four firm, and some of it was to focus on Bitcoin more because the bigger firms there are certainly people that are focused on it, but just given the role I was in the national office, and it wasn't viewed very favorably, and I was just having more opportunities to help these companies. So I ended up leaving, and a lot of that was to focus on this. So there was clearly a misunderstanding, along a lot of the traditional firms or banks, and there still is, but there's a lot more acceptance on Wall Street. Some of the banks are very constructive. I mean, Cantor is one that's obvious, that has supported a lot of the Bitcoin treasuries, has purchased a lot of Bitcoin itself. So it's interesting. People, I would say, a year ago, if you went in with somebody that had no interest in Bitcoin, they probably would say, "No, that's crazy. I don't want to. That's just speculation. Not interested." But I would say now they'll listen, even if they don't have a background. They're listening. It's interested. It's been the best returning asset of the last 15 years. There's a lot, the regulatory clarity, Wall Street really. There's been more money raised related to Bitcoin transactions this year than any other industry. So it's it's starting to catch on. People are starting to be more open, but it's still pretty early. So you're finding, I found that whether it's firms or banks, investment bank, some are there and are very constructive on it, and then some are not. They're just they'll get there later.
Well, look, I think you said it, or the quote of the day is, it's still early. We've been a couple of years now at this and kind of the Bitcoin world. So it feels more natural to us, but then you zoom out and you kind of see the broader landscape, and it is still early, which just makes me bullish. And it's just an exciting time to see this. And I expect a lot more innovation in the capital markets around it. And I think you're spot on that, I come from the oil field. You make your money, and the volatility is your friend if you can be patient and disciplined. Right. I think we're going to go through a process where people are going to learn that the volatility is your friend in Bitcoin if you, from first principles, have the right view long term. I also love kind of layering on, underlying cash flowing businesses. It's a really interesting differentiated asset class. So I'll keep my ear to the pavement. I'm excited to hear more from you, and I commend you on doing that.
Yeah, thank you. I one of the quotes I found in this differentiating Bitcoin from maybe other crypto was when Bezos asked Warren Buffett, your strategy is simple. You buy and hold these companies. Why do people not copy you? And he said, well, people don't like to get rich slowly. So that's the thing I like about it. With cash flowing businesses and Bitcoin, you can just be patient.
Yep. Yeah. Well said.
So, but I appreciate you having me on. Thanks, guys.
Thanks, Grant.
Good discussion. I like this format.
We'll have to have you back. No, it was really interesting. Yeah. Thank you.
Yeah.
That was Grant Switzer, former partner at a Big Four accounting firm, and now a advisor to Bitcoin Treasury Company.
From Big Four to Big Bitcoiner. I like the story.
From Big Four to Big Bitcoiner.
So, awesome. Well, all right. Well, hey, let's move on. I wanted to kind of keep talking in the tech space.
Yep.
Broadly here. A few days ago, article really caught my eye in the free press, And the Free Press is a great thing to subscribe to. I recommend it. It's generally paid, but they send out some of these articles. Um, they email them out for free, and this one really struck me. It's the title here is "Our Shared Reality is About to Self-Destruct," and the picture at the top of this is a somewhat famous picture of Joseph Stalin, and he's got one of his lieutenants, Nikolai Yezhov, and it's kind of the picture of the two of them standing by the river, and then you've got another one where he's gone. He's just been erased, right? And so maybe this was like the first deep fake that that was broadly distributed. But the author here, Ted Goya, I think touches on something that really is of a serious nature. I'm not going to read the whole article. I encourage people to go and do it, but I want to read a couple pieces of it and for us to discuss this both from a moral perspective, but it's also an impact on business, on investment, on innovation, and I think we have to be mindful of it. The article's about kind of this brave new world we're entering, where reality kind of almost doesn't exist because AI is sort of flooding social media, traditional media, often with it can either just be slop or just outright lies. He says it is now possible to alter every kind of historical record, perhaps irrevocably. The technology for creating fake audio, video, and text has improved enormously in only the last few months. We will soon reach, or may have already reached, a tipping point at which it's impossible to tell the difference between truth and deception. At the current rate of technological advancement, all reliable ways of validating truth will soon be gone. My best guess is that we have another 12 months to enjoy some degree of confidence in our shared sense of reality. But what happens when it's gone? So he goes on here to highlight what I think is really the most prescient and kind of frankly disturbing side of this. It says many people won't have the toughness or resilience to survive this environment. A rise in mental illness is not only expected, it's already happening. But we also must anticipate new kinds of mental breakdowns never seen before. On August 11th, psychiatrist Keith Sakata wrote on X that in 2025, I've seen 12 people hospitalized after losing touch with reality because of AI. He links to a Reddit thread from a user whose partner's AI chatbot began talking to him as if he is the next messiah, leading him to believe he's a superior human. This, Sakata says, is AI psychosis, and it's spreading fast. I think this term AI psychosis is going to become, unfortunately, kind of a new word entering the cultural awareness here. And the area where it's kind of most disturbing is as it pertains to children. Even recently, there was kind of an expose on Meta, and I don't even mean to call out Meta because I think the issue, we've seen it here with OpenAI, and it's across many companies, but it was just highly inappropriate internal documents around the interaction of the AI with minors, with children as young as 8, dealing with really kind of intimate subjects that I don't even really want to go into here. But what I'm getting at is you have this kind of revolution going on in business, this AI-powered sort of all this innovation, this greater efficiency, economic growth, but at what cost? What are we missing? I can tell you, you think about just kind of the period everybody goes through when you're 13 years old, you're kind of awkward. It's hard to find your social way forward in life. I can tell you I'm thankful that there weren't AI bots around that are these kind of sycophants that just tell you what you want to hear. It's even been disturbing to me to see like Elon Musk on X promoting these kind of companions that resemble sort of, adolescent girls. And it's a bizarre thing to see sort of the acceleration of the adoption in the business community and the real risk of this AI psychosis. I'm going to stop short of kind of demanding the government. I don't even know what the full appropriate government response is, but there have been many bills around the deep fakes already, creating liability for businesses that perpetrate that kind of stuff. My prediction here, and as I read the article, I think in the coming months you're going to see some major, probably led by state attorney general, major lawsuits, huge settlements from inappropriate and psychosis type driven events. And it's really an unfortunate thing. And it's part of what I think businesses need to think about. Like we can embrace a technology, but we missed this one with social media. It got completely out of the train left the station, and all these kind of really damaging harms came from that. And we're seeing a similar thing with AI that he's highlighting in this article.
You're right. And it's the age-old adage that Benjamin Franklin is often quoted as saying. In fact, it's misquoted from the historical record, but the point still stands. The man who is willing to trade some of his liberty for security will have neither. And we've seen that time and time again with technology. And this is another trade-off scenario.
Yeah.
Where AI psychosis and also the mental health effects of AI are pitted against the tremendous economic and productivity enhancing benefits that this technology is already unleashing, both commercially and just for average citizens, average human beings who have access to it, which is 99% of Americans. So I'm torn because typically let's innovate and let's figure out the regulatory guardrails, but let's
your dad just like me.
Yeah, we don't want to. Exactly.
Yep.
I've got three kids, and we don't want to build those guardrails too early to stifle innovation. But we can't have no guardrails because then we have, this technology can run amok faster than, was humanly conceivable before, because the speed at which we're reaching AGI is accelerating, and some people think that we've already reached AGI. Let me save you the time. It just depends on how you define AGI. Most, serious
it's a promotional term
people in science
fundraising
would say that we have not reached it yet, but again, it does depend on how you define it. So I guess my concern here is the author elucidated some very interesting societal impacts that I had not yet considered related to shared trust and shared sense of reality that you kind of feel is breaking down a little bit. And it's going to accelerate. I took a video of myself. I trained an AI avatar of myself on video footage of myself and used that AI avatar to share some information. And I had done that a year or two ago, and it was very choppy. It was very obvious that it was AI.
Yep.
I did it a few weeks ago, and it was only moderately obvious. It was, you could have fooled some people, right? You can't fool my wife or friends, but you could fool someone that hadn't met me before.
Yeah.
In person. And so what he's saying is in 12 months, that technology is going to be so good that you can't. So the tools to combat it need to be, you have a little bit of a kind of a free rider problem, a little bit of a collective action problem with how do you develop and monetize tools to combat deepfakes and other, AI psychosis related, even just some of the psychology and some of the mental health drag on humanity that will be a result of AI psychosis. There's really not a clear path to monetizing the innovation in that way, where there is a pretty clear path in the traditional sense,
right?
For the actual AI technology and chatbots and LLMs and video, deepfake development of videos. And one example that comes to mind is BitTensor has a platform. One of their subnets is an AI deepfake detection subnet, and there is a monetary
on that one.
Yeah. There's a monetary reward for doing that. And I know BitTensor's not publicly traded, so we can't talk about it on the show. But
not investment advice.
Not investment advice. And I know we were thinking about university, and Bryce having just come out of university. What can you not learn from AI that your professor? And I'm an adjunct professor.
Yeah, I'll just make the point, and this is provocative, but I don't really care. I mean, the point is that university is now completely obsolete. I mean, honestly, before AI became the main dominant, I mean, I knew what NVIDIA was when I was 16 because I played video games. I knew they've been around a long time, so it's not like I just came to this conversation. But you can love them or hate them, and I don't really love these people. I'll just say the Tate brothers have an online university called, The Real World. And regardless what you think about them personally, the value you receive from things like that is exponentially higher than any university anywhere in the world. Whether that be, and there's a lot of people who do. I mean, you have course sellers on all kinds of subjects. Drop shipping over the past, decade have made a lot of very young millionaires. So my point is that another point y'all got to is that, in 2 years, I mean, you're going to have companies, they will not hire new people. It will be GPUs. And people will say, well, let's look at like, doing trades and doing, blue collar type of work. Well, that's great. But, have you seen robotics recently? And people say, well, that can't happen. Well, that's what the Army said about the Wright brothers plane. And so I think that, in 2 years, I saw a lot of kids I went to school with, and they're getting a degree in accounting. Like, oh, well, I'm set for life. No, that's the most quantitative, repeatable thing possible.
Yeah.
I mean, you're not going to have a job in 2 years unless you're high brass and you're running whatever firm you're at. And I know a couple accountants that are, like, hey, look, we're implementing, AI verticals. We're not hiring new people long term. So, yeah, I think it's ironically, AI has made entrepreneurship safer than getting a career path.
I like that. Yeah, it's no, look, it's sobering insight, but you're living it firsthand. Kind of the whole landscape is being disrupted. The author continues here. He gives like an interesting kind of framework, and it's he says, we once disagreed on the interpretation of events. Now we can't even agree on the existence of events. In this new degraded world, we will see 6 behavior patterns emerge: skepticism. If events can't be validated, I can't give credence to anything. Aloofness. If everything gets called into question, I have no basis for shared communal actions. Silence. If discussion no longer resolves anything, I have no reason to speak. Indifference. As I lose connection with the people and events, I lose interest in them. Distrust. In a world without a shared reality, no expert or institution can earn my total trust. And finally, hostility. As these traditional connections break down, it won't take much time to set off conflicts and violence. He says people and organizations are already trying to adapt. In-person job interviews are coming back because online interactions aren't reliable anymore. Educators are returning to pre-digital techniques, handwritten exams, face-to-face teaching for the same reason. And I think what you've highlighted is you also have these new communities online and all different kinds of kind of direct-to-consumer education avenues. And as that reality kind of breaks down, it just feels like, how do you keep together this kind of traditional 4-year experience? And your point is like, you can't. It's sort of this like reveal moment of it's coming to a close. Really a bizarre time to.
Well, I think you also
be alive in
consider
that regard.
it's more broad in society as well. I mean, what happens when, okay, we're going to automate the entire Amazon warehouse. Well, that's great, but what happens when 60% of your user base that purchases either lose their jobs, number one, or number two, their business they own is deemed irrelevant by AI? What are you now? And so I think it's sort of a self-destructing system, because at some point, well, who's gonna be the consumer to purchase what you have?
Yeah.
Right. And so I don't know. That's a very peculiar thing, but I mean, I would say it's not cavalier to say 80% reduction in a lot of white collar sectors.
Yeah,
I mean,
and you're seeing some of that already. And I like what you said. Entrepreneurship emerges as this kind of like safer avenue in a world that kind of lives through this AI disruption. I'll give something a little more positive though.
Sure.
And I want to highlight, because it is an interesting kind of turn that the author gives in the article here, and relevant to some of the discussion we had today. He says, I also have hope that technologies with built-in documentation and resilient safeguards, maybe like a blockchain or the Internet Archive, can help us. For too long, technology has made it easy to erase information, but we will soon have a greater need for technology that preserves it. In fact, I have a hunch that the next big thing in tech just might fix the mess created by the current big thing in tech. But we also need safeguards for reality in the physical world. I envision procedures that will operate like the chain of custody at the police headquarters, where evidence of real-life events is presented from interference and contamination. I can imagine new career paths in the near future. People might work as custodians of reality, a kind of high-powered version of today's notaries. Their job will be validating the actuality of events and media. And this actually happened recently with the recent publication of, I think, GDP and maybe some employment data that the US government published, definitely on the Bitcoin blockchain, I think on a few others as well. There's a fair amount of commentary around, is this is kind of a gimmick? What's the point of this? Well, as this kind of phenomenon starts to continually play out, and a simple press release doesn't really cut it anymore because it's so easily faked and propagated, there is, I think, a growing application of encryption and distributed ledgers for use of kind of protecting that the chain of custody of reality, as the author puts it here. And it is an interesting thing to think about, sort of the new careers. You have disruption. It's going to be bad for some careers. That's any technological advancement. But then new kinds of subject matter expertise and human involvement emerge through that as well. And I thought that was an interesting kind of take within the article here of what the future holds.
One thing, if I can, on this is that, the cost of living is getting, extraordinarily high for a lot of people. One point, this is something we'll probably talk about in the future, but the new opportunity zone legislation that came in the Big Beautiful Bill that's expanding the opportunity zone that has no sunset. And now we don't know the zones yet, but it's going into more rural areas.
Yeah.
So it's going to drive investment out of bigger areas to go build fabs or cities. So I think, one of the big things that the younger generation is talking about, like, well, how in the world am I ever going to have any equity in the market when 88% of the market is owned by 8% of the population?
Wow.
I think you find that, and that's real, I'm not making that up. I think you find that going to these new opportunity zones where there are manufacturing jobs, there are factories being built, is going to be the way people have actual equity in the economy, and not sort of, well, I'm in Dallas and I make $1 million a year and I'm still a renter because, things are so expensive. I think that's probably going to be the solution to that. Of course, I don't know, but it would seem to be the only pathway forward.
I like the outlook there, and that's what this kind of disruption. You have an entrepreneurial sort of wave. People can reassess where the centers of employment are. That's interesting.
And one thing that you said that is, in my mind, beyond refutation is entrepreneurship is key. The percentage of people that run their own businesses or that are in sort of an entrepreneurial endeavor is very low in the United States comparatively to globally.
Yep.
And that needs to change for a lot of reasons, but AI is the primary forcing function that will change that. Andrew Yang said that 5 years ago in one of his books. Of course, he's a entrepreneur himself and has been thinking about AI disruption for a long time. And, the data is bearing it out. There are, particularly for entry-level jobs, there is a decline in the amount of hiring taking place at large firms for entry-level professional white-collar jobs. That is also undisputable. So whether or not that will continue or not, we don't know, but it does seem like a trend, and I think entrepreneurship should be on the up, trending upwards as well, for no other reason than it's just a necessity.
Yeah.
That it happened. And then the other thing that I wanted to comment on is about institutions. I think what you guys have said about institutions is true, but I do think that there will be some institutions that are nimble enough to change, and I would hope there would be, because institutions, whether some people rail against them, but they're actually pretty valuable for society, and we can't lose them all at the same time, because that is chaos and anarchy. But if we can keep some institutions, and I'm saying some in each category, right? You have some rule of law institutions, higher education institutions like universities. You have even just some norms and institutions around like social cohesion and shared trust, and the way that we consume media and talk about ideas in the public square. We have to maintain some of those institutions, and the ones that will be maintained are the ones that are nimble enough to adjust to this new environment. And so I think that's probably a podcast for another day.
Yeah, it's a long topic, but in any disruption, there's winners and losers. I agree that you got to hope for and believe that good ideas will rise to the top. We're going to be hosting the TexCap conference on the SMU campus, and that's an example of a university that they've got a new president. They're re-energizing the school. They're innovating. And that's the kind of discussion that I think could be front and center. I'm going to end with a quote about truth, because I think we've been grappling with this for centuries. So it's not a new thing. It's maybe a little scarier with the advent of AI, but centuries and centuries ago, Plato said, "No one is more hated than he who speaks the truth." I just thought it was just an interesting thing to reflect, that from time immemorial, humans have been talking about what is reality, what are the implications of that. And so this is just a new chapter in that. This has been a great first episode of Texas Capital Live. A lot of interesting perspectives. Just an exciting time to be a part of this movement, and looking forward to next week.
Yeah, that's right. We're really grateful for the team at AMS, our production team here. We will be back with you next week. And every week before now and the TexCap conference on the 8th of October. Awesome. Let's shut it down.